Fundamentals of Accounting Module 3, Lesson 6. Lesson 6, Adjusting Entries. The fifth stage of the accounting process. Keeping the books accurate at period end. At the end of every accounting period, whether monthly, quarterly, or annually, businesses perform adjusting entries to ensure that their financial statements reflect the true financial position of the business. Adjusting entries are essential to apply the accrual basis of accounting, which means revenues are recorded when earned, even if not yet received. Expenses are recorded when incurred, even if not yet paid. Why adjusting entries are important. Think of your accounting records like a snapshot of your business. If that snapshot includes outdated or incomplete info, like unearned revenue still sitting as a liability when the job's already done, your picture will be misleading. Adjusting entries help with matching income and expenses to the right accounting period, recognizing what's been earned or used, even if no cash moved, ensuring assets and liabilities are accurately valued. Types of adjusting entries. Adjusting entries fall into three major categories, plus other commonly overlooked adjustments. 1. Accruals. Record what's incurred but not yet recorded. Accrued expenses. Expenses that have been incurred but not yet paid. Example, you received a $2,000 utility bill in December, but will pay it in January. Entry. Debit, utilities expense $2,000. Credit, utilities, payable $2,000. Accrued revenues income that's been earned but not yet collected. Example, you earned $1,500 in interest from a loan in December, payable in January. Entry, debit, interest receivable $1,500. Credit, interest income $500. 2. Deferrals, adjust for cash that was received or paid before it's earned or used. Prepaid expenses, expenses paid in advance need to be gradually recognized. Example, you paid $12,000 for a 1-year insurance policy on October 1st. As of December 31st, 3 months have passed. Entry, for 3 months. Debit, insurance expense $3,000. Credit, prepaid insurance $3,000. Unearned revenue. When a customer pays in advance and part of the service has now been delivered. Example, a client paid $10,000 for a 2-month service in December. By year end, 1 month's work is done. Entry, debit, unearned revenue $5,000. Credit, service revenue $5,000. 3. Depreciation, allocate cost of fixed assets over their useful life. Businesses don't expense large assets like equipment all at once. Instead, they recognize a portion each period. Example, equipment cost $120,000. Useful life 5 years. Monthly depreciation $2,000. Entry, debit, depreciation. Expense $2,000. Credit, accumulated depreciation $2,000. Additional adjustments, often overlooked but important. These are not always on the radar of beginner bookkeepers, but they're vital for accurate reporting. Inventory adjustment. At period end, match your inventory records with the actual physical count. Example, inventory at beginning, 50,000. Inventory at end, 40,000. Goods used, sold, 10,000. Entry, debit, cost of goods sold, 10,000. Credit, inventory, 10,000. Supplies adjustment. Supplies are purchased and used gradually. Only the used portion should be expensed. Example, supplies bought, Srider 5,000, remaining 2,000 used, due 3,000. Entry, debit supplies. Expense SCOW 3,000. Credit, supplies 3,000. Interest receivable, accrued revenue. Earned interest or rent not yet collected must be recorded. Example, earned thousands in December to be received next month. Entry, debit, interest receivable, Pfizer 1,000. Credit, interest income of 1,000. Summary table, common adjusting entries type, debit, credit, reason accrued expense, e.g. utilities payable, record unpaid expenses. Accrued revenue, receivable, e.g. interest, revenue, recorded but uncollected income. Prepaid expense, rent, prepaid asset, recognize the portion used. Unearned revenue, revenue, recognize income earned. Depreciation expense, accumulated depreciation, allocate asset cost. Inventory, cost of goods sold, inventory. Record the inventory used. Supplies expense, supplies expenses, used supplies. Takeaway for bookkeepers. Adjusting entries ensure your books speak the truth. They help tell the real story of your business, whether it's the quiet buildup of an unpaid bill or the gradual use of office supplies. Without these entries, your income might look inflated or your expenses too low. They may feel technical, but they are the heartbeat of honest accounting. End of Module 3, Lesson 6.